Good day to everyone. Uh, I was in the subject area of stock basics. I was taking you all through certain important um, points regarding investing and trading, and I covered a certain section of the concept called risk management. So, when it comes to investing and trading, what I mentioned was that an investor invests consistently throughout their lives, and traders trade consistently throughout their lives. This is a little bit different to the the theory and the definition that is available uh, if you search for for the subject area of investing and trading, uh, which means that investing is considered as long term and trading is considered as short term. But my experience is that investing and trading are done by investors and traders. And on as far as the investors and traders are concerned, they will be investing and trading throughout their lives. Uh, so why trading is considered as short term? It's not the trading that is considered as short term, it's the trade. The duration of a trade for a trader is short term compared to the duration of a an investment of an investor. That is why it is called as short term. The trading, meaning trading is called short term, is due to that reason. The fact that we or a trader gets into a trade with a short term mindset, a short term strategy, right? Due to that reason, the definition is given as uh, given as for investing. The definition is investing is long term, and the definition for trading is called short term. You got to understand that. Thereafter, what I mentioned was that I was explaining the concept of risk management during that previous session that we had, uh, and I was going through these. I hope for people who participated in that presentation and also the others who didn't participate, this will benefit. And I didn't complete the entire presentation, so here I have decided to complete the presentation, which will help every one of you. What is risk management? Risk management is the process of identifying, assessing, and controlling risks, and it helps protect your capital from significant losses. And it's a good risk management, or rather, a good risk management strategy ensures consistent growth in your portfolio. Um, so, as mentioned here, in order to in order to manage the risk, you need to identify the risk. You have to assess the risk and you have to control the risk. Why you have to identify, assess, and control? That's the question. Because invariably, a lot of people who are deciding to open a CDS account and start investing their hard earned money, they do not consider, of course, when they are opening the account, they answer the question of risk disclosure, but only a few have gone uh, more steps further to understand what the risk is all about, right? So you need to first of all understand the risk, right? If you do not understand the risk, then you will not be able to really control or manage the risk. That's why first of all you have to identify that. Then you have to assess the risk based on your trading or invest based on whether it's an investment or a trade. Then you need to understand to control it. The next point is identifying, assessing, and controlling the risk, right, will help you to avoid losing your capital, right? So first, that's why I have started with giving you the key points in this concept of risk, because see, making profits, growing your capital, and rewarding out of that, those are the positive aspects of investing or trading, right? If your money is growing, if your capital is growing, that's the positive thing. But if you do not understand the negative part of it and try to start investing, right, it's a dangerous and unfortunately a frustrating affair, right? So we have to understand, we have to we have to um, uh, be aware that understanding the risk and managing it will help us to protect our capital and avoid significant losses. The next point is, when you have a good risk management strategy, it helps you to consistently grow your portfolio, right? Consistently will help you to increase your capital, your invested amount of rupees. And why is risk management important? The reason why risk management is important is that it prevents large losses from wiping out your portfolio, right? Understanding the risk will help you to secure, protect your capital so that it will not, uh, you will not get into a situation where the portfolio is wiped out. The money that you have invested is completely wiped out, right? And it helps in making rational decisions, right? Here I have mentioned trading decisions. It's not only trading decisions, rational investment and trading decisions. The reason is, see, at any given moment, you can buy shares, right? Whether the market is up or down, you can buy shares. But if you do not have a reason behind why you're buying that share, right, to make it much easier, if you want to buy that share as an investment, or if you want to buy that share as a trade or as a trader, right? Those are the questions, those are the two important questions that you need to ask yourself if you want to put your money at a certain period in the market, right? At this point of time, if you take from last September 2024 to now, the market has grown tremendously high, right? It has gone up in a matter of 5 6 months to gone up beyond 50%, right? Due to that reason, you need to understand where you are in terms of the risk, right? What is that risk? Is it risky to invest now? So that's why the recognition of risk, understanding the risk is very important, right? So when you understand that, you will, right, I mean, this is how you are thinking rationally, right? whether this is the right time to trade, whether this is the right time to invest, or if this is not the right time and still you want to invest, how are you going to do that? Are you going to invest the full amount that you have, or you want to invest a percentage of that? These are the points that you consider when you're making a rational decision, right? Improves long-term profitability. Due to this reason and the improvement of your discipline, it helps you to increase your capital in the long run. That's why I said you can be a trader and you keep trading based on the principles, the proper way of trading, and keep improving your profitability, your growing of your capital in the long run, right? There are individuals, their their approach to the market is always short term. That is how, I mean, they're comfortable doing short term investments, which are known as trades, right? They're comfortable in doing that. Due to that reason, uh, they have to improve on that. They have to have a system of doing that, which will help them to enjoy what they are doing, right? But if you are a person who is comfortable investing and holding that for a longer period of time, then you have to structure your approach according to that uh, preference or that liking that you have inside you, right? Then the types of risks that you can see in the stock market are, in particular, the first thing is the market risk, because the prices fluctuate, right? In the market, it happens in minutes, in days, in hours, in weeks, in months, in years, right? The fluctuations are always happening. So the shortest periods, like the minutes, hours, or days, fluctuations are much faster and greater than perhaps in weeks and months, right? And the fluctuations will be much slower in the longer periods, like yearly, if you take, right? So you need to understand this concept of price fluctuations, and it happens within trends, right? So we will be learning about trends, and I have mentioned, or I have shared the types of trends and all in the previous presentations, right? We will be talking about the trends, because understanding the trends, identifying the trends, making use of those trends, controlling your risk within those trends, all have to be thoroughly absorbed into yourself. Otherwise, it's going to be very, very difficult. Then the next thing is the liquidity risk. Now, here I have mentioned that the difficulty in buying and selling stocks at desired prices. There are instances where even if you want to buy, you can't buy an X amount of shares at a certain price, right? It's difficult at times. But there, I mean, when the demand is high, this happens, right? You are unable to buy at the price that you want. On the other side, when the supply is high, you will not be able to buy, or sell at the desired price, right? And that is one aspect of the liquidity, right? So there are companies where relatively the the activity of share transactions, the number of shares, right? It's not only the concept of liquidity is to understand that there are more shares, more quantities or volumes available for those particular uh, companies, right? If you take, let's say, uh, John Keels, you have millions of shares, but there are other companies which do not have that kind of exposure. So, in terms of different companies, also, you have different amounts of shares available for trading in the market, right? So, at the same time, you have that in percentage terms as well, right? There are companies where uh, about 30 to 40% of their issued capital, the number of shares that are in issue, can be traded in the market. But there are instances where there are companies which have uh, an amount of maybe 3 to 5% available for shared, transactions in the market, right? Those are called illiquid counters, right? So the difference between liquid and illiquid counters are considered in terms of percentages, right? So that is that is one aspect of liquidity. The other practical aspect is what I mentioned, uh, depending on the demand and the supply, right? There are instances where even um an illiquid counter can have more shares if the market is coming down and the supply is high. You can buy any amount of shares, right? On the other hand, even uh, the same thing applies to a liquid counter, a counter where you have 30 40% in circulation in the market, right? There again, you have instances where you won't be able to buy or sell depending on the demand and the supply, right? Even a liquid counter, when the demand is high, you may not be able to buy. When the supply is high, you may not be able to sell at those prices that you want to sell at, right? You will get stuck. So, say for an example, if you buy a stock at 100 rupees when everybody were buying, right? You went up and bought at 100 rupees. Then you want to sell this after going up to after buying at 100 rupees, it could have gone up to 200 rupees, right? Now you have made 100% return. Then you want to sell and you are waiting until it goes up more and more, more and more. And then what happens is that, okay, it has gone up to 200 rupees, but still you want to hold uh, because you think it will go up further, right? So the duration of it going up further is also difficult to really quantify. It can be, within days it can go up, or within months it can go up, or within years it can go up. Then what happens if the price comes down? Are you going to hold when that 100% decreases to 50%, to 20%, to 10%? The tension, the pressure, the stress that you have, the anxiety increases. Then you become not a holder, you also will get into the supply side. So the supply will increase. At that point, when you take the decision, uh, the share would have been 200 rupees. But then it comes down. By the time you enter the order, it's at 150 rupees. What are you going to do? Are you going to sell that? Right? So these are things that um, that are involved inside this liquidity risk, right? Then you have the operational risk, right? Errors in trading, fraud, technical failures. Now, these are things which you have to be mindful of. The errors in trading means, say you want to buy. Now that you have been spending a fair amount of time in the market, now you have shares. Now this X company you want to buy further. Unfortunately, instead of a buy order, you have gone and placed a sell order, right? You wanted to buy, but now you have sold, right? So you have to buy back again, right? So those are the errors. So you got to be careful beforehand. You have to know whether you're buying that share or selling that share, right? Then you select the correct order window. If you want to buy, you select the buy window. If you want to sell, you have to select the sell window. Then there can be frauds, but that's a rare thing in a regulated market, in a well-regulated market. The next uh, um, of operational risk, which can happen, you know, not frequently, but you will encounter that, will be the technical failures, right? Now, technical failures, one of the main issues will be, if you run out of power, right? Can be your computer, your smartphone, right? The battery will lose its power. That can happen, or there is a power cut or sudden power failures, right? And then there can be uh, issues in the strength of the data signals, right? That's another technical failure. Then there are instances where the system itself, the online trading system, can have issues. So it's not only one operational risk that you have to consider. You got to be aware of these things. That's why I mentioned that this has to be a rational decision, right? You have to take all these things into consideration. Your concentration is not only looking at the profit potential. You have to give more time, energy, knowledge, experience into the risk side more than the profit side, right? Don't don't try to go and go and make profits and have that as your goal. You have to have a proper system first of all, right? You have to understand how the system is working. Then you have the systematic and unsystematic risk, meaning market wide risk versus individual stock risk. See, the market it is not only about the stock, about that company, right? Or the companies that are listed. It depends on outside forces, the macroeconomic side, the technological failures, political, mainly the political, then economical issues. Those are the main issues that we have. Then you will see different types of social issues, then technological issues. So you got to understand that it's these are considered the risk involved in a market. So you got to be aware of those, because if there are some negative things that are happening outside the market, that can affect the market, affect the trend of the market. So you've got to study them, right? Then inside the company also you have those issues, where the company, maybe it was successfully making profits. Now they have issues, right? And the profit growth can come down, or maybe the profitability is coming down. So those are other risks. So basically, the risk can be um, divided into these four main parts, but you got to understand and study them before even thinking of putting your money into the market, right? Then understanding the risk to reward ratio and position sizing is another important area that we need to be aware of. This area, you need more knowledge. What is risk to reward ratio? This helps you assess whether the trade is worth taking. For an example, if 1 rupee is your risk, then you can have rupees as your reward, right? So, in that sense, if that is the case, the risk to reward is 1 to 2, right? One time risk as against 2 times 2x reward, or it can be 1x risk as against 3x reward, right? So that is that's something that you need to be mindful of. Now, see, when a stock is at 10 rupees, and it's let's say that is the that is the bottom of that share, that price, right? The 10 is the bottom. Now you can see that previously it has gone up to even 15, 20, and you see a potential, right? So in a scenario like that, you can have a 1 to even 5 times risk to reward ratio, right? Because you have that potential of an upside. But let's say this 10 rupee share has now gone up to 90 rupees. Then you got to, you cannot have the same mentality, right? You need to understand whether the risk is high compared to the reward. If the risk is 10 and the reward is 2, right? So these ratios will help you to assess your risk to reward ratios and decide whether it's worth taking, right? So remember that these are very important uh, disciplines that you have to include, or disciplines that you have to use and improve when you are investing and trading, right? Then position sizing. Allocate a fixed percentage of your capital per trade, right? Meaning, in the case of position sizing, is a little bit different to the rupee cost averaging. We will be talking about the rupee cost averaging. Previous presentations also have mentioned about rupee cost averaging. It's the same thing, but different concepts. Position sizing and rupee cost averaging, we make use of percentages of our capital. But the way we look at it are different. Right now, position sizing, we look at the risk involved, right? Based on the risk, we will be using the amount of rupees. For an example, let's say I want to buy uh, a share at 10 rupees, right? Then I figure out the risk is 1, which is 1 rupee, right? Now that 1 rupee, and if I am thinking of um, risking my capital, let's say I want to risk, I don't mind losing 1% of my capital. Let's say that capital is 1 million, right? So 10,000 rupees will be your 1%, right? So you don't mind losing that 10,000 rupees instead of losing the entire 1 million, right? So you have figured out that percentage that you are willing to risk, you are willing to lose. That is 1%, right? So this 1% is 10,000, and your risk in the share price is 1 rupee. Then you divide the 10,000 by 1 rupee, which means 10,000 shares, right? So 10,000 shares at 10 rupees you will be buying, right? And even in that 100,000 rupees, you will be losing only 1,000 rupees or 10,000 rupees, right? So what you need to understand then is that, okay, I'm using 10,000, sorry, 100,000 to lose 10,000. Now you have 1 million in your capital. So you're putting 100,000 to that trade, buying 10,000 shares at 10 rupees. Then you will be losing 10,000 rupees if it comes down to 9 rupees, right? Now, if you think it's too risky for you to put 100,000 and lose 10,000, then you can even scale it down further. It can be then the allocation, or rather the money that you're risking from your entire capital, will be lower than 1%. It can be 0.5%. That is 5,000 rupees. It can be uh, point, um, 0.1%. 0.1% is 1,000 rupees. So this is why you have these systems, right? You will decide when you understand the position sizing, then you can uh, structure it, plan it out the way you want in order to handle that risk. What is the risk that you can tolerate? I mentioned, I can remember, I was asking you all whether you're okay, comfortable in losing 1,000 rupees, 10,000 rupees, or 100,000 rupees. Where is your comfort zone? That is very important. Right? So here I mentioned you should not risk more than 1 to 2% of your total capital on a single trade. Right? So I went one step further and said, if the 10,000 rupees is not what you can tolerate to lose, then this 1% can be much lower than that. So as an alternative, what you can do is you can start very small, the smallest possible amount. That is why what I mentioned previously as well. Start very small, and then little by little, as you gain knowledge and experience, you can increase, right? Then let's look at the stop loss. I mentioned about this, risking 1 rupee, right? That is, you're stopping the loss at 1 rupee and taking a profit, right? I mentioned 10 rupees is the bottom, and previously it has gone up even to 15 rupees, 20 rupees. Now it is at 10 rupees, right? So you're risking 1 rupee to gain an X amount of profits. So as a risk to reward ratio, let's say it's a 1 to 3 risk to reward. That means you buy at 10 rupees to sell at 13 rupees, but you're stopping your loss at 9 rupees, right? So there is a order type in the online trading system. There's an order type called stop limit order, which I will be showing you all when I'm talking about it, right? That's a little bit of a complicated, advanced technique, right? So you start small, and then you will get to know what it is all about. Uh, the idea is you're limiting your risk to that particular rupee value, right? That is what the stop loss order is all about, right? It automatically exits a trade at a predefined loss level, right? Then you have another system called trailing stop, right? Meaning, say, now you bought at 10 rupees, you have entered a stop limit order at 9 rupees, right? Then the stock goes up, your target is 1 to 3. It goes up to 13 rupees. Now you have 3 times profit, but still you feel that it will go up further, right? So you can change that stop limit order. Instead of 9, you can take it up to 13 because it's trading above 30. When the stock is trading above 13 rupees, it can go up to 15 rupees. So you're coming in and keeping it at 13 rupees so that you have already, if by any chance something happens, your initial target of uh, 3 rupees is already there. Now you're trying to get something extra out of that trade. For that, we have this order type called trailing stop. See, in other markets, we have an order type called trailing stop. You have a window, right? And you have to allocate different percentages there. And then the system itself will automatically keep increasing when the prices are going up. And if prices come down, then at that time it will reach the prices will come and reach the trigger level, and the trade will go through. Here we have to do it manually. So for me, it is it is really interesting because we can manually keep changing these orders so that our the thought process that is available for us to learn the trailing stop is available, because we are each and every time we will be amending that order, we will be canceling and entering a new order, right? In that process, we have not only the compute is helping us, we ourselves will be helping ourselves in understanding what this trailing stop is all about, right? So these are uh, things that are available in the online trading system, which you can use initially. Now, most importantly, this is done, and these are very wide subject areas. Stop loss itself is a wide area. Trailing stop also is a wide area. So we need to understand the the subjects and how to benefit out of it, and then make use of those types of orders. Then the take profit also, you can place a limit order. So you buy at 10 rupees, now the price is going up, then you have already decided to sell at 13 rupees. You can make use of a sell limit order. There is a sell limit order, or an order type called limit order. You can use that order type and place your price, or rather place your sell order at 13 rupees. That's different to taking the stop to 13 rupees. You can take this, for that, you have to wait until it goes up to 13 rupees, right? Until it goes up beyond 13 rupees. To take a trading, or to put a stop or limit order at 13 rupees, it has to go above 13 rupees. Take profit order, we will be um, entering before it goes up to 13 rupees. So I hope you can understand the difference. Diversification and portfolio management, right? So there is this thing called don't put all your eggs into one basket, right? Similarly, don't put all your money in one stock or sector, right? There are different sectors in the market, different stocks within those sectors in the market, right? So you should understand not to put everything into one sector or the entire amount of rupees into one company, unless, of course, there is another extension to that rule or definition. There are companies which are doing businesses in different sectors. We are calling them diversified companies or conglomerates. They own different companies in different sectors, right? So they I mean, investing into that kind of a stock itself is diversifying your investment, because they themselves do business in different sectors, so that when one company is not doing well, uh, then you will be able to invest into those counter. I mean, if one sector or a company in one sector is not doing well, the other sector may do well, so they can compensate against each other, and they will be doing that inside their company. So investing into a company like that will help you to diversify as well, but that is not the basic concept of diversification, right? So you need to figure out whether you like to invest into a diversified company, or you would prefer to invest into different companies in different sectors. That's according to your own strategy. Then you can diversify across different industries, right? So that is another thing that you can do. You can understand how the economy is working, right? Recent, I mean, in a few days we will get the budget, and we will understand who will benefit out of the government policies, which sectors will benefit out of it, right? And then we can understand, or we can figure out the stocks that we need to invest into. Then, of course, we can consider different asset classes, right? Stocks is one asset. Similarly, there are one asset class. There are different types of asset classes. Uh, uh, Here I have given stocks, fixed deposits, money market funds, right? You can move from stocks to different asset classes, at different periods, so you got to understand that don't keep, I mean, if you have the opportunity, you have the opportunity, you have the opportunity to keep money in different asset classes, right, at different times. So you need to understand that if the rates are moving up, it will be beneficial for you all to keep a percentage of your capital in those types of deposits that will be helped by the increasing interest rates, right? So that is very important. Then trading psychology and emotional control. This is another area which is very difficult for a lot of people to master, right? Because your mind is the weakest organ in your body. Your mind is the weakest organ in your body, which needs your assistance. If you don't assist the mind cannot help you to grow your capital. Mind itself will not help you to grow your capital, right? So don't get carried away by the mind. You have to instruct and train your mind to understand how to manage the risk, right? This fear and greed are the biggest enemies in trading, right? The same concept of weakness in your mind is explained in two different ways, are called the greed and the fear, because it's the same mental process that tells you either to fear or greed or be greedy, right? So you got to. That's why you have um, the risk to reward ratio to avoid the fear and the greed, right? And understanding the level of the risk to reward ratio will help you to understand how far the danger is, how far the opportunity is. Say a stock, as I mentioned, was at 10 rupees, now has gone up to 90 rupees, right? At 10 rupees, the risk to reward ratio would have been 1 to any amount you want. But at 90, how much? You need to understand. I won't say that from 90 it is 10, right? But at 90, you have to understand whether that opportunity is still there. The same opportunity is still there, right? So that way you will be able to control the fear and greed. So if you do not know what are you doing, that is the time the fear comes in, because you don't know, you don't have any plan. You just bought, somebody told you, or maybe you have heard about these things and you just bought, right? That won't work. You have to have your own plan. Why? The reason that you bought, reason why you are thinking of selling, at a higher price? Why are you thinking of selling at a lower price? Right? You have to have rules for those. Then, in order to control your mind and improve your trading psychology, you have to stick to your trading plan. You have to have a plan and avoid the impulsive decisions. Allow the plan to work. That itself will need time. Some people within days will understand how to get used to working within a plan. Sometimes it takes months. Some people, they have taken decades. Over the last 30 odd years, with my experience, I have seen people, they are still in the game. They have not learned. So that means they don't have a plan, right? When you have a plan, you can improve on it. If you don't have a plan, you don't have a starting point to improve anything. So you need to have a plan. Then, in order to improve the plan, you have to keep a trading journal to analyze your mistakes, right? And what to have in a trading journal. Okay. In a trading journal, the key, the important thing is the trade information. What time, especially the date, even if you don't have the time, right? The date when the trade was entered and exited, when you bought, when you sold, right? Remember, I said stop loss, meaning you're selling at a loss or selling at a profit. Both are exits, right? So your buy date and time, sell date and time. Then the stock. What is the company that you bought? Direction, whether you bought or sold, whether it was a sale or a buy. Then the entry and the exit prices you need to have, right? Then the position size, number of shares, contracts, or units traded, right? How many shares that you bought. Remember, I showed you all an Excel sheet uh, for the rupee cost averaging method. You can use something like that, right? You don't need to have, you know, what do you call, if you buy a list of shares at one particular date, right? Then obviously you should be recording them. You can have in different formats. It all depends on how comfortable you are in maintaining those records. Then once you enter into the stock, you need to have your stop loss and target prices. Then once you execute the orders, right? If you have used these, you have to have those data, the prices mentioned, and then whether you have made a profit. Whether I mean you have two different things. Here I have mentioned the actual profit, meaning the realized profit in a portfolio. Until you sell, it is an unrealized profit or a loss. Remember that. Until you sell, it is an unrealized profit or loss. Once you sell only, it becomes a realized profit or loss. Right? Remember. Then, of course, the commission and the fees. In our case, the commission and the fees is all straightforward, right? So you can all. It's not rocket science to calculate that. Then the second point is the trade rationale and analysis, right? The reasons behind why you bought those, right? Then you need to have the setup and the pattern. Describe the technical pattern, fundamental catalyst, or other reason for entering the trade. You got to be specific about it, right? Example, if you're using technical patterns or technical analysis, you can say you're waiting for that breakout of resistance to buy, right? Or otherwise, fundamentally, your the market expected a different earnings, um, or other different earning price to earn, sorry, earnings per share, right? But the company has beat that expectation, right? So that is a positive thing. If that's the reason why you bought, then in the case of technical indicators, right, it can be the MACD crossing over the signal line. Then the strategy or the system, which trading strategy or system did you use for this trade? System, of course, our online trading system. The strategy, right? What is the trading strategy? There are different types of trading strategies, right? So you got to choose. We'll be talking about those types of strategies and all. So we will be looking at. I mean, you have to work that out and see what is the strategy or the trading system. Then the indicators, if you are using, as I mentioned, the MACD, list any technical indicators that you are using, moving averages, RSI, Fibonacci retracement tools, MACD crossovers, whatever. Market context. What was the overall market condition at the time of the trade? Is it a bullish uh, um trend, or a bullish condition, a bearish condition, a volatile, a quiet condition? You got to, you know, list that out. Then the risk assessment. How much risk did you take on the trade? Percentage of capital risk, or the risk to reward ratios. You need to, record them. Expected outcome. What was your expected outcome for the trade? The profit target, potential loss, right? I mentioned about the stop loss, how much you want to put, how much profit that you want to get, right? Those you have to mention. Then the next thing is the trade management, right? Uh, when you got into the trade or in that investment, did you stick to the plan, right? Or did you follow your entry and exit rules, or just bought it, just sold it, right? Because this is happening. This happens to every one of us. We will have one, I am deciding, okay, this is why I'm going to buy this. But the moment I go into the market, I see it's going up, then I just jump into it. Now, then what happens is, then only once I purchase that, only I realize that I have not stuck to my plan. It happens. So never mind, at the start, you might do that over and over again. But uh, over time, the amount of times that you are making the same mistake will reduce. That is why you need to have that plan and sticking to the plan. You can make mistakes, right? You can make mistakes, no worries. But if you stick to it, if you want to increase the discipline, you will, over time, you will get out of it and start following the plan. Any adjustments made during the trade? If you have made any adjustments, let's say the price is going up, you want at 13 rupees after buying at 10 rupees, price is going up, you have decided to wait with that trade, you have to mention that, right? How did you manage the trade? Was it a trading stop, partial profit taking? You have bought, let's say, 10,000 shares, you can sell, and your target was 13 rupees. You sold 5,000 shares there, balance 5,000 you are keeping. So there are thousands of ways of managing your trade, right? Thousands. It's not only one or two. There are so many ways. But bottom line is, you need to have your own system, right? Then the emotional state. In the case of the emotional state, how did you feel before, during, and after the trade? Were you confident during that trade? But then the moment you got into the trade, you were You became fearful, anxious, excited. Then you hear different stories about the market, about the world, about this, that, and the other. What happens to you, right? These are the emotional things that you need to record for each and every trade. Did emotions influence your trading? Did emotions influence your trading decisions? If so, how? Right? You need to write them down, because if you have the same state, same influence, emotional influence over and over and over and over again, then unfortunately you will not succeed. So if you're using the same mistake and you're avoiding it, cutting down the repetitions, then you will be able to improve on it. Lessons learned and review. You have to keep reviewing your the lessons that you have learned. That's why I said this is an individual's journey, right? Whether you're an investor or a trader, this is an individual journey. There will be people to help you, and you can make you know get assistance from a lot of sources, but this is your individual journey, right? So due to that reason, you need to uh, ask yourself and write down with regards to the things that went well in the trade, right? uh, what could have been done better, you need to write down. And what did you learn from this trade? If you don't have any learning points from this trade, that means you have to improve further. How can you apply these lessons to your future trades, right? Is another thing that you need to review on. So you got to study them, keep writing them, reflect upon them. Screenshots and charts is another thing that you can include in that journal, right? You can, but of course, um, if it is important, only you can do that, because images will help you to understand. After a while, when you look at those images, will I mean, you will realize how helpful that would have been. Tips for maintaining a trading journal: you got to be consistent uh, in keeping it. You have to record every day everything, what you have lost, what you have won. You have to detail them, provide information as much as possible. You got to be honest to yourself, right? This is your capital, this is your money that you have decided to grow, right? So you need to be honest with you. If you have made mistakes, accept them. And the next thing after accepting is to avoiding them. What are you going to do to avoid them, right? And when you succeed, celebrate them, right? Enjoy them. Review regularly. Periodically review your journal to identify patterns, strengths, and weaknesses. Remember, I said this is about the mind. You're training the mind. That is why you are doing all these things, because that is the weakest organ in your body. Remember that. Whether you are the successful person on earth or the unsuccessful person on the earth, the mind is the most challenging organ, right? You can be successful. You can show to the world that you are successful. But inside of you, you may be frustrated. That is because of the mind, right? So you need to groom the mind. You need to give the mind the proper nourishment for you to become the correct and the uh, and the and the successful investor or trader that you want to be. So that's basically what I had to share with you all in this presentation about risk management under the theme of investing and trading. Next, presentation, I'll be taking you all through the different types of investments and trading. And, the next basic, let me put it this way. The next episode, I'll be taking you all through some of the other important aspects of with regards to, or which is helpful for you when you are investing and trading. Till then, thank you very much.